So imagine a world where real estate investing can actually rival the stock market in both liquidity and size. We're going to dig into that and more with Neil Bawa on today's episode of Ready to Scale. Hey guys, I'm your host, Jeanette Friedrich, Director of Investor Relations at Blue Lake Capital. And as I mentioned, we have got Neil Bawa here with us yet again on the show. For those of you that don't know, he is the CEO and founder at YouGrow and Grow Capitus, two commercial real estate investment companies that are heavily technology driven. He has a current portfolio of over 4,800 units with a transaction volume of about $1 billion. He previously was the COO and executive VP of Unitech Information Systems. He has a bachelor's in science in computer science from SAIS College, which is essentially the University of Mumbai. And he's joining us today from San Francisco, California. So Neil, welcome to the show.
Well, thanks for having me on the show. It's great to be back, and what an interesting topic to talk about.
Yes, absolutely. We've had a lot of negativity. We've all beaten, a lot of subject matters to death, like, the
Yes.
impending debt crisis and interest rates and cap rates and valuations. So I thought everybody might appreciate just, a kind of small break from that as we dig into kind of some more fun stuff to think about. Like I, kind of hinted towards in our introduction there. But before we get into that, I do want to talk about your background. So, I know that you've been on a lot of podcasts and spoken at tons of events, but your background is something really interesting that I've never actually bothered to ask you about. So I know that you came here as an immigrant from India, and what I'm curious to know is how has your background influenced your approach to both business and risk in US real estate investing?
Okay. So when you talk about my background, the first thing you have to know is that I am autistic. So when I was 9 years old, I was diagnosed as being autistic. As I would speak, in the middle of my speech, bunch of numbers would come out, and then I would continue speaking. And I wasn't aware that I was speaking those numbers. My mom initially thought that I was going nuts. And so because my dad was a fighter pilot, they took me to the Air Force hospital. And luckily there, the right person, the right psychiatrist found me, and he sat me down and he tried to understand why these weird numbers are coming out of my mouth. And what was really happening was that my mind was at the same time perceiving the universe like most people do, right? So, you look at what's in front of you and you think about it, and also look at that same universe in numbers, just raw math. So I would look at somebody, for example, and they're standing in front of me, and my mind would start computing the size of their nose. So I would say, okay, well, look at the hypotenuse and look at this, and that nose looked like it's 1.72 inches long on the diagonal, and it looks like it's maybe about 0.7, 0.8 inches on the horizontal. And I would do that math randomly with random things, no particular logic behind it, with all things in front of me, right? So I would start to do that math. I would, if I'm looking at cars, I would calculate their speed, right? And at what point, not just their speed, but their rate of acceleration, things like that. So I was doing it in a random fashion, and I was not aware that some of those numbers were coming out in my speech. I wasn't aware, I couldn't tell that. So the person told my mom that this isn't a disease or a problem, this is a gift. And so my mom said, can you please figure out how to suppress it? And he said, no, 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 no. I am not going to teach your son to suppress this. I'm going to teach him how to coexist with it. So he has to learn how to simultaneously do these two things and not have them overlap with each other. So that was the training that I received at the age of 9, how to basically take the math side of my brain and let it do its thing. So it's doing it right now. In fact, the entire time that we've been in this podcast, I've been computing things. And since the only thing I can see right now is you, all of the computation things are something about you. And it's just random, it's weird, and it often doesn't make any sense, but it does it all the time. And I was taught how to ignore it so that it doesn't overlap into my daily worlds, right? So I didn't say any weird numbers, even though I'm thinking numbers right now. And that separation is what I was taught how to do. So
That
it's
is
been a gift. It's
fascinating.
been a gift that I've had all of my life. And that's why when I'm in a podcast, I quote very specific numbers. I make relationships between different sorts of numbers. Before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neil's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content. In India, one of the advantages that we have is that we are taught how to do mathematical calculations in our head. So, you learn, and many Indians know how to do this. I wouldn't say all of them, but I'd say a third of the people in my class knew how to do a very large amount of mental math. And it was taught to us in such a way that there was this sense of competition, everyone competing, so whoever has to come up with the fastest answer. So we learned an incredible amount of math, and we learned how to apply math to things in the real world, as opposed to, quantum physics or particle physics. We learned how to apply it from a statistics perspective. And so when I was running my tech company, so I came here as a technologist, I got a job at a tech company in 1997, perfect timing. And by 2000, they promoted me to VP of operations and a partner in the company. And then I ran that company until 2013 when we sold it to a private equity firm for a pretty large amount of money. So we built it from 10 employees when I joined to 400 on the day that we sold the company. So it wasn't a .com or anything like that. It was a regular technology company that, had products and services that was selling, tens of millions of dollars in revenue. And so as I was going through that process, I was very, very concerned about the amount of money that I was paying to the taxman, right? I live in California. I have a big fat tech salary. So 54% of my salary, including Obamacare taxes, was going to, state and federal. And so I became obsessed with the idea of taxation reduction. In 2003, the founder and lead partner in the company decided we didn't want to rent. We decided to build our own custom campuses. No investors, no debt, all cash. Let's build a campus for our company. And I got involved in that process. It was terrifying because, we were running a company of, hundreds of employees during the day. And then in the afternoon, and evening, we were basically building our campus. And as I went through that process, at the end of it, I realized the power of depreciation, because the depreciation from that campus massively reduced tax bills, right? Absolutely incredible reductions. And then I went on to build 6 more campuses for the company over the next 5 or 6 years. And my own taxes reduced over time to the point where I had a big pot of money by the time 2008 came around. So going back to what you said, right? My mindset is really tied around the use of large data sets. And I'll talk about the sort of data sets that I use in real estate, and we'll also talk about, the topic of this podcast. Will connect those. My goal is to use large amounts of data set to come up with unique ideas and concepts that may not occur to you if you're not churning through an absolutely flabbergasting amounts of data. Right. Mm-hmm. So what I'm most known for, so there's about 35,000 investors that follow what we do and they use our data. There's 12,500 people taking my real estate analytics course on Udemy right now. And basically these people follow us because we rank things, right? And the things that we rank that are the most popular are cities in the United States for investment. There's 1,016 cities and 323 metros in the US, and we rank them every month. We have no access to grind. And sometimes I don't know anything about the metros that show up at the top of the ranking. I have no idea, right? So, recently Northwest Arkansas shows up at the top. Now I know why, because I've done my research. But Burlington, Vermont showed up about 9 weeks ago and has consistently stayed at the top. And I'm now trying to learn more things about Burlington, Vermont, because I don't know anything about Burlington. And so those are the sort of things that we rank. I rank lots of other things, to be honest. I rank, for example, the kinds of tomato seeds that will grow you the biggest fat tomatoes and fastest tomatoes. So things catch my attention. Some of it has nothing to do with work. I'm obsessive compulsive, so I will continuously take pieces of data set and rank them. So that's really the background. That's the mindset, and that's why I have the moniker, the mad scientist of multifamily.
Mm-hmm. Very, very fascinating. Really interesting. I can see how it can definitely be viewed as a gift. I can see how it probably could also be a little maddening at times. It makes me think of the movie Pi. It's an old movie. I don't know if you've ever seen it, but yeah, very interesting. Very interesting. Now, what about how do you view risk?
I view risk in different ways from other people. So one of the things that when I look at risk and when I compute risk, what I've learned, and this has been painful for me because I was doing the exact opposite of this a while back, is when everyone else believes that there's very little risk in the market, that is the point of maximum risk. So in early 2022, let's call it Jan, Feb, March, everyone and their mother was buying properties. Every property had 20, 30, 50 offers.
Mhm.
And when you go back and look at that, that quarter was the lowest cap rates the United States has ever experienced. Since then, those cap rates have gone up, which means prices have gone down. And that at that point, I don't think you could convince anyone in the syndication industry that they were in an extreme risk period. You couldn't convince anyone at all. So what I've learned from that is to compute and calculate the points where no one believes they're taking significant risks. And that point inevitably tends to be either the peak of the market or very close to the peak of the market. And so what you don't want to do is never participate in that opportunity. You should wait for 18 to 21 months after that point, and then you get plenty of opportunity. So I, like everybody else, wanted to participate in these hypes when they happened. And I luckily did not participate in the one in 2022 because math was showing me that I was going the wrong direction. Previously, I learned from the COVID, crisis. I learned from what happened in 2017, 18, and 19. And that's what I've learned about risk. The point of maximum risk is the point at which other people think there isn't any.
Interesting. It mirrors somewhat the words of course, the famous saying by Warren Buffett, to be fearful when others are greedy and be greedy when everyone else is fearful. Yeah, very interesting. But
Yes, but I think you have to compute the risk. That's the difference, right?
Mhm.
So, Warren just looks for times when others are fearful, right? To me, I want to go the other direction as well and want to compute the time when others are greedy. I really want to observe markets where there's greed. Now, what's nice is in multifamily, we've actually settled from a point of absolute greed and absolute confidence to a more rational thought process. Uh, the whole syndication industry is better today than before, even though we've taken a huge amount of hits in the media, which we deserve, by the way. But but I think the industry is more mature today than it was, 12 or 18 or 24 months ago, and that's a good thing that's happening. So that's what I'd like to tell you about risk.
Interesting. And, I can say that to an extent, I definitely agree with you. I think it's been a very key learning opportunity for many, many investors in the industry, as well as, sponsors. And it's not been enjoyable, as most lessons in life are not, the hard ones, but the valuable ones. And I'm curious to see, how many people will remain in the industry after going through what may be their first downturn. We'll see how it all shakes out, but nonetheless, so we'll
Go
jump
ahead.
in next to talking about your vision for the real estate market being able to actually rival the stock market in both liquidity and size, and what has to happen for any of that to come to fruition. But before we do, let's go ahead and take a break so we can hear a word from our sponsor. Ready to Scale is brought to you by Blue Lake Capital, where we hunt down the best multifamily investment opportunities that we can find and invite investors to join in with us. We target Class B value-add multifamily properties across the Sun Belt. Our CEO, Ellie Perlman, invests a substantial amount of capital into every deal. This means our interests are aligned with yours. If you're an accredited investor looking to expand your portfolio and diversify sponsors, be sure to visit us at bluelake-capital.com. Blue Lake Capital. Be bold, be extraordinary, and keep moving forward. All right, so Neil, I am loving ChatGPT. I am a big fan of AI. We utilize AI in different ways at our company. I know you are very data-driven and very technology-driven. And so I'm curious to hear what this vision is that you have for the real estate market to be able to rival the stock market, and what kind of technology and regulatory changes do we have to have in order to see that actually come to fruition?
Sure. This is an area that I've been doing a tremendous amount of research over the last 2 or 3 years. I've done, a number of webinars on this. So if you're interested, both on AI and also on, tokenization, fractionalization, whatever you want to call it. Um, so I want you to, I want to use the stock market as my example, right? So today you can buy a share of Apple. Okay, maybe it's $400. I don't know what the number is. It's $400. But you can also buy 1/10 of a share. You can buy 1/20th. We can buy 1,000th of a share of Berkshire Hathaway, because if one share is like $100,000, so you can buy 1,000th of it, right? So when you think about stock investing, you don't think about a unit, you think about fractions of a unit, right? Because of the way stocks are set up, the company has a certain net worth, and based on that net worth, you basically chop that number up into smaller fractions, and people can make investments. You don't need to be accredited to invest in stocks, even though most new investors, almost 90% of them in their first 5 years of investing in the stock markets lose not all of their money, but lose a very substantial percentage of their money. They're not making any money, right? New investors are not making money, they're losing money, and they're learning through the act of losing money. So the stock market is perfectly fine with you not being accredited. It could be the last $50 you have, and you can make an investment through E-Trade or Robinhood. So you
I've never
notice the
understood.
dichotomy there, right? Somehow
Yeah.
in real estate, you have to be accredited and have a $2 million net or $1 million net worth, and they're trying to even raise that limit. But you can go and invest all of your money into the stock market, into some penny stock, and lose it the next day, and that's perfectly fine. Do you see? And these are the two largest markets in the world, right? Now, people think that the stock market is bigger than real estate. They think that, okay, well, we also always hear about real estate as an alternative asset, so it must be smaller. And when you look at the allocations that large funds like the Norwegian fund have made, their stock investments are bigger than their real estate investment. So there's this tendency for people to think that the real estate market is smaller than the stock market. Nothing could be further from the truth. The real estate market worldwide is more than 3 times larger than the world stock market, right? So if you take all the stock markets in the world and capitalize them and come up with $1 number, then you look at real estate is more than 3x the size. So real estate is by far the largest asset class in the world. Nothing compares, nothing comes close, right? But that asset class is not democratized, right? If I go to a party today and somebody tells me that Burlington, Vermont is the best place in America to invest in, which, by the way, my software says that and has been saying it for the last few months. I haven't been paying much attention to this because it's a small market, but that's what it's been saying. I can't pick up an app, right, like Robinhood or E-Trade, and I can't make a few taps on it and basically make a bunch of investments into Burlington, Vermont. But if somebody says mining for lithium is a very big deal, right, and you should make investments in it, I can take the E-Trade app or Robinhood, select lithium, come up with a list of companies, boom, 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 boom. Within 5 minutes, I can make a huge amount of investments into lithium. I don't know anything about lithium, but somebody just told me it's awesome, right? So I'm going to make that investment. That's the difference. Real estate is not democratized in any way. It takes months or years of research to understand real estate, single family, multifamily. Even buying a single family property is hundreds of hours of work, including going to that, market and boots on the ground and driving around to 100 different properties. So this entire market is extraordinarily illiquid when you compare it to stocks and many other markets like Bitcoin, which is also a liquid market. Now, the Jobs Act was designed to democratize this. So in 2013, the Jobs Act happened, and really the syndication market came out of that. right? And so 2014, syndication market happens. And since then, syndication has become a way of democratizing real estate. And it's had its own good and bad because like any hype industry, we've had, a lot of bad deals happen, a lot of, overpayment happen. But any industry matures over time, and this process of interest rate hikes is actually helping us become better at our job. So I'm sure the second decade of syndication will be better than the first. Now, when we look at that, though, the Jobs Act only started this process because any process of democratization goes through lots of different steps. The step that we didn't get particularly well done or well baked was fractionalization, right? So with syndication, sure, if you're accredited, you buy a share, $100,000, you invest into a particular property. But what we haven't had yet, which is inevitable, and there's 50, 60, 70 companies working on this right now. I have investments with one called Stowbox. I like them. They're Europe-based. But there's DigiShares. There's a bunch of others, right? So these are two examples. Plug in these two examples into ChatGPT and it'll give you 20 others that are doing the exact same thing. But basically what these companies are looking to do is to say, okay, now the next step isn't a $100,000 share. It's a $100 share. It's complete democratization. I should be able to invest $1,000 into 10 different multifamily properties with a single click, right? And these can be from 10 different syndicators. So it could be one property from Neil Bawa and one property from Ellie Perlman and a bunch of others, right? And I should be able to do that, right? Whether that's a good strategy or not, I don't know. But democratization is not the process of creating good strategies. It is first the process of being able to do something, and then over time, people will build good strategies on top of that. Just like the stock market, if you look at it in the 20s and 30s, it was just crazy, insane stuff that you can't do anymore because regulations and rules were passed to prevent people from making stupid mistakes. But when the stock market started, it was just a free for all, right?
Mm-hmm.
So I think that what has to first happen is access, and then access leads to people doing wrong things, then that leads to regulation, and then that leads to safer strategies of the sort that you see in the stock market today. And that is about to happen. I believe that 5 to 10 years from now, you will be able to have a water cooler conversation. You will be able to talk about a city, a particular asset class. You'll be able to say, for the next 3 months or the next 3 years, Airbnb in Miami is a fantastic deal. And I should be able to go to an app, type in Airbnb, and I should be able to select a bunch of different properties and say $100, $100, $100. Boom, I'm done. I just invested $1,000 into 10 different properties. And you might say, yeah, I can do that with syndication. No, you really can't. No, you really can't, because when you look at the number of investors in the stock market in the United States, roughly 1/3 of Americans are invested into the stock market, right? But the total number of people invested in syndication hasn't even hit 1 million yet, right? So it's hundreds of thousands of people as opposed to 50 million or 80 million people. Also, people throughout the world invest in the US stock market. We are the number one stock market in the world by a very long shot. And somebody in Japan or somebody in India can buy our stock all the time, right? We can't do that with real estate. We can't even buy our own stock in the United States without extraordinary amounts of pain. So syndication is simply a precursor to where we are going. It is a path. And in its current form, syndication won't even exist in 10 years, right? Whatever that new form is, hopefully we will transition into that. I wouldn't bet on it. But whatever that path is, it is going to be much more democratized. And I think what will end up happening is we will need to be much more transparent with our properties. When a stock is doing poorly, when you have a public stock and it's doing poorly, like it's missing its returns, or something bad is happening like Boeing, right? Well, a door fell off a Boeing aircraft, and now there's 5 million memes on the internet about this. Jon Stewart is making jokes about it, because the way the stock market functions is with almost complete transparency, right? And in the future, when we buy a $50 million building, we're going to have to basically, provide equivalent levels of transparency that will allow AI, artificial intelligence, to rank our shares and to basically say, this property is a C minus, this property is doing at a B level, this property is an A or an A plus, this property is overperforming. All of that, we're thinking, who the heck is going to do this? That's a ridiculous amount of work. Even Ellie Perlman's, portfolio has dozens of properties. Some are doing really well, some are doing not so well. Who's going to figure this out? The answer is simply 2 letters, A and I, right? What will end up happening is we will, when we wish to play a role in this larger market and we want millions of people to be buying stock in our buildings, we will connect our property management software and our accounting software into a AI portal. That portal will then suck all of that information in, right, from us, and even will come to our webinar. So we do a webinar for our investors, right? Well, the AI will simply connect through Zoom. Maybe we're using Zoom, and it will suck in that video. Did you notice that we just yesterday was the most important day in the history of the world, bar the birth of Jesus Christ, because ChatGPT 4.0 came out, right? If you don't know what that O stands for, it stands for Omni. And Omni is better than ChatGPT 4 in that it understands all forms of video, right? So it basically now can real time talk with you, see you. And as you can imagine, within months, it will be able to join as a participant into your Zoom call and absorb that content. And if you allow it to, it can use that content. So imagine several years from now, AI platforms that we as syndicators pay money to basically take all of the information from our property management software, investor management software, and other software, tuck it in transparently, and you get ranked. And you might say, why would I want to do this? Well, why would public companies want to do that? There's people saying that, so-and-so stock, like Nissan, just got rated junk bonds. Do you think Nissan wanted to be rated as junk? They don't have a choice. The stock market is transparent. So transparency comes with 100x or 1,000x the opportunity. But it also comes with the fact that, if the emperor doesn't have any clothes, well, everyone can see the emperor, and everyone can see that the emperor doesn't have any clothes. That is the direction that real estate has to go in, from this dark hole that we are in right now to extreme levels of transparency that match that of public companies. And we will choose to do that because we don't want to have a few 100,000 investors. We want to have 100 million investors. So we will make that choice, and we will take the hits that some of our properties that are not doing so well are going to be ranked on portals. And that's just life. And again, the way to do it is artificial intelligence, because I don't believe that it's possible for us to do it the way that we've been doing it in the last 5 years. People have been trying to tokenize. They've been trying to fractionalize. Well, if they want to fractionalize a property, they need to somehow rank the quality and performance of that property. And that's completely subjective, because they have to hire a third-party company, and that third-party company has to then dig into it and then rank. Oh my God, that's just, how many properties are you going to do that for? There's a million, multifamily properties in the US. But what if there were third-party companies that were using ChatGPT-4 Omni, right? And there were hooks into your software, and it was doing it in real time, and it was ranking it. It would probably be pretty shit in the first year, but by the second year, it'll get better, and the third year, it'll get better. By the time it's been doing it for 3, 4, 5 years, it's at least as good as the stock market. And when somebody says this stock is junk, I believe that. The stock is probably junk because it's rated as junk. And if somebody says this is an AAA rated company, then I think it's probably a lot better than that junk company, right? And again, the ratings are not perfect. We know that from 2008, when all of these these securities were rated as A++, even though they had all kinds of garbage in them. But things have gotten better since then, right? And rating services themselves are the first users of AI. Can you imagine a better use of artificial intelligence than rating companies that have to rate 6,000 public stocks every single day of the year? They're using it tremendously. So we're all getting better at ranking and rating. That's the vision. The largest market in the world, $300 trillion, is completely opaque, and had to be completely opaque because every property has a different level of performance. And now within the next year, we're going to go from opaque to almost perfect visibility. And this allows hundreds of millions of people to buy real estate the way that we buy stocks. This is inevitable and will come with both demand destruction and demand creation.
Very, very interesting. There are so many items that you brought up, different topics that we could actually segue into. What I will say first is, given the private equity structure and component, the alternative investment status that we all hold, the first question that I have for you, just to simply challenge the thought for the fun of it, is who would lead the way in this? Who would lead the charge in this? Would it be technology driven that would ultimately force this kind of transparency and fractionalization of real estate investing? Would it be the SEC, the feds? Who would initially be the one to lead the charge to bring this about? Or would it actually ironically be venture capital?
So the technology already exists. There's 50 different companies that are currently taking millions of dollars from venture capitalists to tokenize real estate, right? DigiShares, Stobox, these are perfect examples. As you said, legislation, and we'll talk about that a little more, has to change or get tweaked for that to happen. But you know what's the bigger thing that has to happen? It's not the legislation and it's not the technology that's stopping us. What's stopping us is the manual process of ranking the quality of each multifamily. That process is currently manual. When it goes from manual to being automated through AI, which is inevitable and will happen in the next few years, anyone that has an outperforming fund will go first. So as you can imagine,
Sure.
companies that are able to show a consistent level of performance will go to the web first. And they will basically form that early majority. Tesla, the early Teslas, they were all people that were enthusiasts. Well, these will be enthusiasts. They'll go out, they'll buy this stuff because they can clearly see that these companies are overperforming. And if the companies are overperforming, again, it's not rocket science to connect your accounting or your property management. And the numbers, we all know them. A property that generates a higher net operating income is going to do well. A property that has a lower interest rate is going to do well. It's OPEX expenses. A lower OPEX expenses is related to higher performance. But the truth is, everything I just said is already known to ChatGPT Omni. It already knows how to rank real estate. Somebody needs to build an app specifically to do that and suck in the information. So the answer to your question is all the companies that are outperforming will go first, right? And what'll happen is over time, their performance levels will go down, but now they're already transparent, so they won't have a way back. And then there will be pressure for other companies to move up if they want to play in this field. So more companies will move up. At a certain point, you get to the point, the tipping point, where pretty much everyone has to start doing this, because if you don't do this, people are like, what are you hiding? Right? Are you hiding something? Is your performance really, not as good or worse than anybody else? Because, well, all these other companies, they're ranked by ChatGPT real estate. So I'll call it RE ChatGPT is ranking all these companies, but you're not doing it. So there must be something wrong there, blah, blah, blah. So I think that's what's going to happen. It's going to need to happen. I can tell you that when rating companies such as Moody's, started up, the stock market was up in a upheaval, screaming, yelling, complaining, saying these ratings companies know nothing about our business. They know nothing about our future. They're always going to rate us incorrectly. They, blah, blah, blah. There's going to be human error. Nobody listened. And eventually, every single company that was public started to get rated because you had no alternative. If you want a market that's 100 times the size, you need to be 100 times more transparent. So kicking and dragging, everyone is going to be forced into it.
Very interesting. Very interesting. I don't know that it will be in 5 or 10 years' time. I think that's a little optimistic. I think one of the big challenge is going to be buy-in and even getting people to agree upon streamlined operating systems or property management systems. There's still some of those old, privately owned owner and operators that don't even have software on their property at all yet. I mean, it's kind of crazy. So we'll see. I think maybe a 10 to 15 year window might make a little bit more.
No, I completely disagree. We're going to see early adopters and rankings occur on the internet within the next 2 to 3 years. All of these, there's 50 to 100 companies engaged in this. Almost all will fail. And keep in mind, I'm not saying that we'll get to 100% adoption. That will take decades. What I'm saying is that we will get to a significant portion of organized large buildings, large ventures in the US up there within the next 5 years. What is significant? It could be 5% of all the buildings in the US. It could be 10%. But even 5 to 10% would be an incredible jump, because there are 20 million apartment units in the United States. 5% of that is 1 million units. now I would have the ability to invest in 1 million units. There's somewhere around 3 to 4 million Airbnb units. 10% of that is 300,000 Airbnb units that I can invest in and that I can rank. 10% is more than enough to democratize all of real estate. The remaining 90% can stay behind the wall and take decades to get there. It's the first 10% that creates democratization. And by the way, the people who benefit the most are in that 10%.
Sure, definitely. I can see the logic in that for sure. Now, let me throw another obstacle or challenge in your way, which of course is going to be regulatory compliance, right? So I have been actually following very closely what's going on with basically the Small Business Committee, Advisory Committee to the SEC, and the recommendations that they are putting before the SEC for the changes to potentially to the definition of an accredited investor. And what's very interesting is their recommendations are actually much more liberal than I had anticipated initially before watching the meeting. Basically, what they are proposing to the SEC, their recommendation is to actually remove some of the challenges for barrier to entry for your average everyday investor and allow those that are not financially accredited to be able to take some sort of test that would then allow them to achieve, quote, that accredited status. So, interesting development that we're watching on that part. But if we take what's currently happening and then look at, essentially this vision that you have for the future, where would accreditation fall into the mix of all of this? Would you anticipate that the regulation would be waived altogether? And that, simply any investor, just like in the stock market, can participate? What do you think happens there?
It's going to become irrelevant. And I'll tell you why. 95+% of all stock market investments are made by people that are not accredited anything. They have no status. And it is completely 100% legal to do so today. There is no regulation required. For example, I would like your listeners to go to arrived.com, ARRIVED.com. Arrived is a company that allows you to invest in rental homes and vacation rentals. You can invest as little as $50. This is a Jeff Bezos-backed company, so the Amazon founder backed Arrived. They've paid $5.5 million in dividends. They have 600,000 registered investors. Most of them are not accredited, and 156 million in assets under management. Right? So they're doing single family. So they show you a single family. It's very nice looking. They say, hey, we've got a renter. Here's the numbers, and you can invest $50 or $100 into this. Right? So if this is already happening, why haven't we democratized this? Well, here's what's missing. No one is actually at this point able to get any independent ranking of the quality of these single family homes that Arrived has on their website. They could be shit. They could be like, this is a horrible rental. Like nobody will ever break even on this. That could be the case, right? So what's holding people back, and they're not really holding them back, as you can see, 597,000 people are registered on this website. That's 500,000 people. So they're making progress, right? But the reason why it's not a much larger number than that, 100x or 200x, is because we haven't been able to rate the assets, right? That's what's holding us back. So when people say regulation is holding us back, my answer is, so is the SEC suing Arrived.com? No, because Arrived.com is using a third-party broker-dealer and a FINRA broker-dealer named Dalmore. Dalmore is a SEC-compliant FINRA SICP broker. And so every Arrived $50 transaction results in a 1% to 2% fee for FINRA and for Dalmore. And Dalmore's job is to audit Arrived and make sure that audit is not doing shady things. Now, obviously, they're not auditing every $50 transaction. They're auditing the process of hundreds of thousands of transactions to make sure that Arrived's doing the right thing. So this is legal. Anyone can go to Arrived.com, scroll to the bottom of the page, and there's a note this big that exactly explains how Arrived is able to take $50 at a time. The regulation is not the issue. It's the black hole of performance that we're about to fix. The moment that happens, Arrived will have rankings on their website from some third-party tool called ChatGPT that will say, this home has a 3.6 ranking, this one has a 3.8, this one has a 4, this one has a 4.2. And the moment that happens, as you can imagine, the one that's 4.2 will immediately get sold out, right? But that's what happens in the stock market. I go into E-Trade, and E-Trade tells me what's happening with the market, PE ratios, income levels, last quarter's numbers. Everything's transparent, good or bad, right? Well, the same thing is going to happen. We are waiting for transparency. We are not waiting for regulation.
Very, very fascinating. Very interesting. Are you going to lead the charge on this, Neil?
I am, and so this is the first. I've appeared on 300 podcasts, so this is the first time I'm saying this in public. I will be launching my artificial investing fund in the next 90 days. Here's what I believe. November 30th, 2022, the day that ChatGPT launched, is a date for humanity at the same level as the birth of Christ. Okay? I'll put it one level under the birth of Christ so that the religious folks don't give me trouble. One level under the birth of Christ and Muhammad. Okay, there you go. Now I'm politically correct. But yesterday's date, May 13th, 2024, will go down as the most significant and much more significant than what happened. Because yesterday, for ChatGPT-4 Omni came out, and it is truly multimodal. This is very hard and far beyond the point of this, podcast. But multimodal AI is a million times more powerful than the ChatGPT that we love and have been using for the last year and a half. This may take several months for people to understand what I just said, but it won't take several years. It will take several months, and then people will understand just how phenomenal multimodal AI is. Beyond this point, every single company in the world has become obsolete and must reinvent. There isn't a company in the world, including Ellie's company and my company, that doesn't have to reinvent because of what happened yesterday.
Yeah. Yeah, I agree with you actually wholeheartedly. I'm already using ChatGPT 4.0, or I believe that's how we're calling it now. I just got it yesterday, but
Yes,
I do think that it is absolutely revolutionary. I think it's very comparable to almost the age of the beginning of the internet. That really did just
that's
change
right.
the trajectory completely for us. And
Mhm.
this is yet another, massive shift in the trajectory of how we're going to live and work and operate. And it's very exciting. I'm a huge
Well,
fan of it as well. So I agree
I'll
with you.
tell you, it's 100 times more powerful than the internet, because the problem with the
Oh yeah.
internet, if you want to call it that, is that it's only digital, meaning the internet, we can click a button and we can do amazing things on the web, right? But what we can't do is click a button and build a house, or click a button and build a nuclear reactor. Whereas multimodal AI, because it uses vision and it has tactility, right? Watch a 3-minute demo on YouTube called Figure AI. Figure Space AI is the first demo that I've seen that is using this new version of ChatGPT-4. And if you understand robotics and how difficult robotics is, we are about to make a quantum leap. So here's what I will say, right? We are in May 2024. In May 2034, we will have at least 1 billion humanoid robots on this planet. So we'll go from zero today, or practically zero. I'm not counting all those robots that make cars. I'm not thinking about them. I'm
Right.
thinking about intelligent robots, right? We don't have any intelligent robots in the world today. So we're at zero, right? 10 years from today, we will have already hit 1 billion. And all of it because of what happened yesterday.
Ooh, very, very bold. Very bold projection, I guess is what I would call that. But I wouldn't say it's far out of reach. I've actually been really enjoying reading the book Species. If someone listening to the show has not yet read Species, it's fascinating. And, one of the questions that the book, prompts you to think about a lot is essentially what are we going to evolve into? And humanoid actually is very logical possibility. I think that we're already moving in that direction in many regards, even when you consider, people that have had, some type of amputees, for example. I mean, that is And that's not even obviously robotic yet, but I recently got a Tesla, I'll admit. So I love my Tesla, right? And the things that it can do. It's very exciting, the directions that we're moving in. And I think it's fantastic that you have the attitude that you do about embracing what you can do with that when it comes to real estate investing. So this AI fund, what will this AI fund look like? Are you going to basically put action behind everything you've just talked about today and make just fully transparent platform of some sort that can begin ranking those owner and operators of multifamily properties that want to get on board early on in this and start to be incredibly, very radically transparent? What is that going to look like, Neil? What are you going to do?
I'm still waiting for someone to come up with a company that does that. And if as soon as they do, that's where I'll go. This fund is simply about investing into AI companies. Again,
Interesting.
because of what happened yesterday and what happened in 2022, every company in the world has to basically reinvent themselves. So the number of opportunities for reinvention in the next 5 years will exceed the number of opportunities for the last 10,000 years.
Hmm.
So, and it'll be necessary, it will be forced, it will be brutal. So this fund has nothing to do with real estate because, as I mentioned, I'm still waiting for a company to crack that concept of transparency. Like, how do you make a single family rental property transparent? What is the process, right?
Mhm.
And I know for a fact, because I'm an investor in many of these companies, that they're looking at it, but their inevitable conclusion was the artificial intelligence is the way to do it, and the AI was not strong enough. But then I saw 4.0 yesterday, 4 Omni. It's definitely the exact description of what they've been looking for. So for the last several years, these companies have been waiting. And remember, OpenAI's model is that they're not really interested in charging $20 for OpenAI. As of yesterday, 4 Omni is free to the world. Anyone can use it because that's not how OpenAI wants to make money. OpenAI wants to be the back end for anyone that wants to create this real estate transparency tool. So right now, if you're a fractionalization company today, you're celebrating. If you're a digitization or tokenization company, you're celebrating because all you have to do is go to the OpenAI website, select the API, sign up, and now you can make calls to that software. And so I think that in the next 2 to 3 years, we will start to see these tools come out. We probably will see one within the next 12 months, but it'll probably suck. But within 2 to 3 years, we'll get one that is good enough so that they start to get sponsors on their platform with transparency. And then I think it'll snowball from there. So we'll see. Call me back in 5 years and we'll see how right or wrong I am.
Yeah, well, this has been absolutely fascinating. I'm very curious also and excited to see how all of this is going to develop. I do agree with you. I think it's going to be rapid. I think the industry, however, is going to drag their feet horrifically at adoption of it. And so, it's going to be a very exciting 10 to 15 years in multifamily real estate, and frankly, the world. I mean, in all kinds of regards, well beyond just simply real estate. So, Neil, very fun. Thank you so much for taking some time to hash it out with me and to actually get very creative and have some fanciful conversations that we usually wouldn't have. Definitely appreciate it. As you might remember, every time I have someone on the show, I always ask them 5 questions that we call the lightning round questions. I've asked you these questions before, but I'm going to ask you them again because I
Mhm.
do believe that people also evolve, and what our advice might have been 5 years ago could definitely be radically different today, given the lessons that we've learned. So, first, my first question for you actually is going to be, what is the biggest lesson that you have learned in the last 24 months of real estate?
Oh, very simple. You can sell yourself on concepts that are simply not true. The vast majority of us, including I, believed that interest rates would never spike again. They could go up again, but never spike, and they've spiked ridiculously. And now, when I want to go back and look at it, there's actually no data for my assumption. I made it up in my head, started to believe in it like a bunch of other people. So, the key thing is that you can drink your Kool-Aid so much that nothing beyond the Kool-Aid is visible.
Very true. Very true. All right. Big question. Are the Feds going to cut rates this year? Are they going to stay the same? Or are they going to actually do another increase?
The Fed will cut rates this year, but probably only once.
I think that's a
There's
reasonable.
a 0% chance that they will increase rates.
Let's hope. Let's hope. All right, very good. Now, the real questions I was supposed to ask you is when you're not, worried about real estate and, seeing numbers floating around people's faces, which is fascinating, and getting really excited about ChatGPT 4.0, what are you also doing with your time? What's a hobby? What do you do for fun?
I'm a life hacker. I like to hack every aspect of my life. I like to, figure out disruptive ways to do things related to health and, all kinds of things. For example, I play an app called Lumosity every day for 11 to 12 minutes. It takes about 11 to 12 minutes to play it. Over 200 games. These are mind games in 9 different areas. So that keeps my mind healthy. I take as many as 21, 22 different kinds of vitamins. It takes a while to take them every day because I like to hack my health. I have an Indian yoga instructor that very specifically addresses the areas that I work in. I pay them $12 an hour. I have a physiotherapist that I work with twice a week, also from India. So I'm using remote services because it just makes sense. Um, I also do, I like to do health tourism. So when I'm going to Bali for my 25th anniversary, I'm also going to get hair punching done so that I have hair all the way to here. It probably cost me a fifth of what it does in the San Francisco Bay Area. So I'm looking to hack my life in as many ways as I can.
Well, that's exciting, and I appreciate that level of transparency too. Most people wouldn't announce that they're going to go get hair plugs, but good for you.
Why not? Why
Yeah.
not? I don't see why not. I mean, you're probably going to see me in the interview with that little line here for the next 4 months.
Well, good. I hope you enjoy the trip and congratulations on the anniversary.
Thanks so much.
All right. Now, last but not least, Neil, if people want to get in touch with you, if they want to get into a fun debate with you, if they want to counter your opinions or join your AI fund, where can they find you?
So right now, Grow Capitalist is the company that buys buildings, not just multifamily, but all kinds of assets. Mission 10K is the company that's building 10,000 rental townhomes. Those are 2 different ways to connect with us. But what I prefer to do is to give you the address of a website called multifamilyu.com. And it's sort of like our Wikipedia for real estate analytics. It's completely free. There's no subscription. We do not provide any educational services. It's simply a place for people to come in and watch 20 thought-provoking webinars a year. About 35,000 people watched webinars last year. So come join the community. That's probably the best way to engage with us, multifamilyu.com.
All right, perfect. All right. Neil, very fun. Thank you so much for your time. For those of you that invested your time with us today, thank you. Please don't forget to like, rate, and review the show. Leave us some comments. Let us know what you think. If you want me to pass a message along to Neil, you let us know, and we'll be happy to do that too. In the meantime, be bold, be strong, and keep moving forward.